Hi, and welcome to this February 2024 buy-to-let mortgage market update. My name is Richard Purnell from The Mortgage Home, and we are your buy-to-let mortgage experts. Now, I've got some great content for you this month. We've got 4 topics. As usual, my bread and butter start with what's happening with the market right now, both in terms of the Bank of England interest rates, my predictions, which if you want to know in depth, you'll have to look back at my January video update for the full prediction for the whole year. But what's happening right now and how that might impact on mortgage rates and what trends am I seeing on the mortgage market right now. So if you're interested in that, then stay tuned. Also, I'm going to look at corporate tenancies. Now, that's not commercial tenancies. These are still domestic dwellings. But I'm seeing a real trend in more landlords starting to look at alternatives to the AST, the Assured Short Hold Tenancy. And so if we're getting into more corporate type tenancies, how does that look from a lender's point of view? Will they have appetite still to lend to you? So understand the pitfalls of that, get it right up front. So if you're looking to branch out to these corporate type tenancies, which quite often look more lucrative, then again, stay tuned for that one. Now, on my third subject heading, I've been a broker for over 25 years, and over that time, I must have seen 20,000 valuation reports. So I thought, man, this should be gold dust for us landlords if I could just tease out what are those common issues that surveyors pick up when they go out to see a property. Because if I could share that with you, then you would know that information up front, do further due diligence, and that could save you time, save you energy, stress, money, maybe allow you to renegotiate, or even chuck that property in the bin because you now realize it was never going to get some traction with lenders. So hopefully that'll be really valuable for you landlords that are actually actively buying in the market in 2024. And my last section today is on joint ventures. So if you already have a joint venture in place, if you're about to set one up, or you think that during this year that you may have to do a JV because that'll help you hit your property goals that much sooner, then there's a particular type of life insurance that have been designed by the insurance companies specifically, absolutely bespoke for joint ventures. And it's going to help protect you and make sure that you achieve those property goals, even if the worst happens. So if you're into JVs, think you're going to be doing them, then you must tune in for that last chapter. So in this section, I'm going to talk about the market. Right now, we are on the 6th of February. And it was last week that the Bank of England met and they decided, yet again, to keep interest rates at 5.25%. Now, it's been 6 months at that level. So we are absolutely in this area of stability. But what I'm sort of seeing to change is, as I've said on my second bullet point there, the mood music, the tone that's coming out of the Bank of England is only subtly, but I'm just picking it up. It's starting to change. Up to now, the conversation around the Bank of England and the commentary that's coming out is, well, should rates rise a little bit further? And now that message is disappearing and is slowly being replaced by, what might the conditions be like before we can start to reduce rates? So it's still only subtle. Now, there will be commentators out there. There will be pundits who are piling the pressure on the Bank of England to bring interest rates down. They're clamoring for it to happen for all sorts of reasons. But my view is, as it was when I did the prediction last month, that we ain't going to see rate reductions anytime soon. Let me explain why really briefly without turning this into an economics lesson. And I ain't no economist. So, look, if for no other reason that if you actually look at the actual voting pattern, because this is how it works, there are 9 people on the committee at the Bank of England that vote once a month as to what's going to happen to interest rates. And even now, when it's been stable for 6 months, 2 of those 9 actually voted for an increase in the Bank of England rate. Actually voted for an increase. So that tells you that we are some way off, I think, in terms of actually seeing rate reductions. But here's the second thing, because the prime piece of data, the indicator that you and I should be looking at as a view as to whether the Bank of England or when the Bank of England might reduce rates is how inflation is dropping. And as we know, and I make a comment on it almost every month, that inflation has dropped from last summer. It was probably in excess of 10%, and it's dropped right down. It's now sat at 4%. And that's part of the reason we're getting this clamour for the Bank of England to start to reduce rates, because these commentators are saying, look, job done, we're almost there. And by almost there, the target is 2%, as a reminder. That's the Bank of England's goal. However, even though we're at 4% now, what is going to happen over the next few months? So make a mental note, if not a written note of this. My view is inflation's going to actually increase over the next quarter. Now, that's not a surprise. That's not my left field prediction. This is also the view of the Bank of England. It's in their expectations. It's in their forecast. There's some, again, we're not getting into the detail, but there's some changes going on with energy prices that will mean that as a short-term blip, inflation's actually going to go up. So when you see the Daily Mail headline or the Sky News headline or the BBC headline saying, oh my God, inflation's going upwards, it's the end of the world, we know not to panic. It's part of the great scheme of things. It is only a blip. And by the end of the year, inflation will be back below the 4% that it's at right now. That is the view. So there's a little bit of a choppy waters, bumpy road ahead, which is why I've been saying last month and will continue to say that we will not see interest rate drops, I don't think, until the end of the year. Now, how does that all translate to mortgages? Well, again, for the in-depth view of mortgages, what I said back in January, if you've got time or you can remember what we talked about then, still holds true. As a real brief recap, there's two camps. We've got the banks and the building societies in one camp. And in camp two, we've got the non-bank lenders, your Kent Reliance, your Kensingtons, your Precise Mortgages, your Aldermores, those types of lenders. In the first camp, the banks and building societies absolutely came out of the traps in January, almost like a fire sale. Mortgage rates slashed massively, and we were seeing 1% reductions on interest rates for buy-to-let mortgages. And essentially, my view was that these lenders were sacrificing profit for market share. So there was massive competition for your business, and that was great for us as landlords if we were a landlord, a smaller landlord that can still go to the high street banks for our mortgages. Those now have that, I guess those reductions have done. So the rates you're seeing with the banks and building societies, probably starting with a 3% upwards, are the rates you're going to be getting. They can't keep slashing rates even further. So I think pretty much there'll be some tweaking and moving around a little bit. But essentially, the rates you're seeing from the banks and building societies are what you're going to get in the short term now. So that's one side. On camp two, with the non-bank lenders, I did say in January that they would not follow suit. They would not be cutting their rates. They would not be chasing volume business. And that's pretty much what we're seeing as we enter February. That category of lender are still holding their rates at what they were at the start of the year. So if you're a larger portfolio landlord, certainly in excess of 10 properties, if you've got more complex needs, if you've got limited company buy-to-lets, holiday lets, HMOs, that type of investment property, then you're not knocking on the doors of the banks anyway. You're on with the non-bank lenders, and your rates are pretty much stable. And again, so when your broker's talking to you about the rates on offer, that's pretty much what you're going to get. Don't be sat on your hands or sat on the fence waiting for rates to drop like they have done with the banks and building societies. That is not going to happen. Said it last month, saying it again. Nothing's changed. So make your decision. And that's my takeaway message for you guys today. If you're active in the landlord, are you waiting to see if you're going to get any more savings? That's unlikely to happen for either camp. So make your decisions now. There is some certainty. That's my view. And so go ahead and get it. If you want to talk about your situation in any more detail, then at the end of this piece, in the commentary underneath, there'll be a link to our online diary. Just have a click on it, have a chat to the team to get the rates that are right for you, because clearly I can only talk generically today. In this piece, I want to talk about corporate tenancies. Now, what do I mean by that first and foremost? Not commercial tenancy. We're not talking about commercial buildings or warehouses or factories. We're still talking about domestic dwellings. But what I've seen as a big trend in 2023, and it's continuing this year, is that landlords absolutely are looking to maximize their profits on the properties they've got. And so rather than the traditional ASTs, which have clearly been suffering because rents can't rise anywhere near to the pace that mortgage rates have gone, so landlords have been looking at alternatives, and corporate tenancy has been one of those alternatives. If you've not heard that phrase before, let me just explain some examples of what I mean by that. So it might be a developer offering a brand new build a property or maybe an apartment, and he or she's offering guaranteed rent for a certain length of time if you have an agreement with them. I've seen letting agents make that proposition to landlords, saying, look, contract with us, we'll give you a guaranteed rent, 365 days a year, no void periods. Whoa, what's not to like? Where do I sign? So really appealing to enter into these contracts directly with the agent or the developer. And that means then it's up to the agent and developer who they have in the property, what type of tenant. It's not your concern anymore. And that means you're no longer in the traditional AST relationship. You've now got a corporate contract. It might be that you are letting the property to a charity. And charities have all sorts of different people in there. There might be people with learning disabilities, mental health issues. It might be a halfway house for people coming out of prison back into community. It might be people trying to escape from domestic abuse. And so it's a safe house. Obviously, the charities have all sorts of purposes. Still want a domestic dwelling, but for all these different sort of setups. And again, these types of organizations might offer very lucrative, profitable rentals that are prepared to pay, and quite often will manage the maintenance. So again, extremely appealing to a landlord to engage in these types of contracts. But here's the thing. The point I want to make on here is that not many lenders will entertain a corporate type tenancy, because unlike an AST tenancy, which is born out of the Housing Act, which is pretty much a standard template, so lenders understand what the content's going to be, there's no such thing with a corporate tenancy. It starts with a blank sheet of paper. It's down to a set of solicitors to put together a legal contract that's suitable for their client. And so I've seen so many variations. Some can be 30, 40 pages long. So as you might understand, a lender really wants to see the detail of those corporate tenancies to make sure there's nothing in there that they would find unappealing or not acceptable. So this is a reason why we need to get under the surface of what these tenancies look like and what type really do lenders have appetite for and what don't they. So I've also put on my third bullet point about a preferred term. Again, there's no, unlike an AST, which is usually 6 to 12 months long, a corporate tenancy can be any length of time. I've seen 10 years, 20 years, 2 years. From a lender point of view, 3 to 5 years is the sweet spot. That's what they like to see. When it gets beyond 5 years, then we start to see a lot of the doors closing on that one. So look out for that. Now, on my fourth point, I've got a section called vulnerable tenants. So first of all, what do I mean by vulnerable tenants? Now, these could be, as a few examples, asylum seekers would be classed as a vulnerable tenant. I mentioned a bit earlier about people with learning difficulties or mental health issues. So if a charity had that category of tenant in the property, that would be classed as a vulnerable tenant. And lenders generally ask on an application, or it might be supplementary information that they're going to request, as to whether the property might be let to vulnerable tenants. Now, why would a lender be interested in that? Well, this will never be in writing. So this has come from experience talking to lenders. Why do they ask about it? Because unfortunately, most lenders do not want vulnerable tenants in the properties. Now, why is that? Why are they not going to be socially responsible institutions and actually still lend on properties that where you as landlords might want to be helping out charities and organisations that are helping vulnerable people in society? Well, here's the deal. Here's the thing. The bottom line is a lender is always looking at, what if I have to repossess that property? That's the lenders. They're not optimists. They're not gamblers. They're very prudent by nature. They're looking at the worst case. And if they had to repossess a property, what happens next? They kick the tenant out because they want to sell the property as soon as possible. And to get the best market price, to get the highest price and get the most demand, it needs to be vacant possession. So can you imagine the newspaper/internet headlines? Faceless, heartless institution kicks out blah, blah, vulnerable tenant. It just would be such bad PR. So unfortunately, lots of lenders will take a step backwards if there are no vulnerable tenants in there. Now, look, if you are thinking of going down that line yourself this year, that's part of your goals. Look, there's always exceptions to rules. You would usually be able to find lenders who can support you, still lend against that. My point is, because I have to generalize on these updates, is that we're looking at the exceptions in terms of lenders, but the rule will be many lenders would walk away from that. The final point here is, it's one thing about purchasing a property and possibly engaging with these different relationships. So what about repurposing your existing portfolio? So lots of our landlords are looking at existing portfolio to push the profits and the rent up. So they're looking at an existing property that's going to have an existing mortgage on there. So we need to be looking at the existing mortgage offer. Does that mortgage offer's terms and conditions allow you now to move from an AST to a corporate tenancy? On the whole, again, I'm generalizing, they will not allow it. So you need to understand where you'll be contravening your T's and C's. Easiest thing is to send it to your broker. We'd be more than happy if you were our client. Send us through a copy of your mortgage offer. Tell us who your lender is, and we will look into that sensitively, confidentially, and give you the feedback as to whether that would be acceptable or not. If it is, great. If not, at least you're armed with that information. And if it's appropriate, then we might move you from lender A to lender B that does allow you to use the property on a corporate basis. So that's the takeaway point from me on this, is if you're looking to purchase, get a hold of that template corporate tenancy agreement as soon as you can. Send it through to us. We're more than happy to tout it round to different lenders, talk to lenders, get them to analyze it and give some feedback as to whether that type of agreement is going to be acceptable. Clearly, the sooner you know that, the sooner you know that you can continue your conversation with those agencies and start negotiating and come to an understanding. And equally, if it's a property repurposing, send us that copy of the details of the offer through. And again, we will tell you whether that's going to be acceptable. So again, at the end of this piece, there's a link in the comment section below. Just click on it if you want to have a chat about a specific property you're either thinking of buying or you've already got on your repurposing. And as part of your property team, we'll give you that really, really useful practical advice as to what you need to do to get that type of tenancy in place and up and running. In this piece, I want to talk about valuation reports. Now, it suddenly came to me that over the last 25 years, I've been a mortgage broker. As a team, and my firm must have seen over 20,000 different survey reports from lenders when you're either purchasing or refinancing a property. And therefore, wouldn't it be absolute gold dust if you could tease out the common issues that surveyors find when they go around and survey a property? Because if we were forearmed with that information, we might not even have bought that property in the first place, or we might have renegotiated with the buyer a little bit more, or we might have done some more planning and more due diligence up front to save time and effort. We might have been able to put other things in place to make sure that that property went through smoothly, which is clearly what we all want. So what I've done today, for those of you who are actively buying this year, is just give you a summary of some of those key areas that are going to help you save time, save money when you're buying your properties. Now, I want to start with EPC ratings. Now, I know that the EPC debate has disappeared. The government have really kicked that into the long grass. However, it's not disappeared completely, because here's the thing. Lenders still have a policy rule when it comes to EPC ratings. Of course, they're not going to be demanding that it's a C or above rating, which what the consultation was all about. However, they will still expect your property to be an E rating or above. So A to E is acceptable, but here's the big point I want to make. There is still 1 in 5 buy-to-lets out there that are on an F or a G rating. 20% of all private rented sector properties are still on an F and a G. So I'm bound to be talking to you, some of you today, who have F and G rated properties in your portfolio. And if you're going, I don't even know what they are, then you've got to get onto the EPC register, public document, just Google EPC register, and you'll be able to see what your rating is. It may even be out of date, which can be another issue. Back to the point. So the surveyor is going to check. If you don't know or haven't looked ahead of time, the surveyor will pick that up. If it's an F or a G, it's a decline. Now, there is an exception to this. Now, I don't want to get into this in too much. I haven't got the time to look on this, but you might want to write this down, that there is an exemptions register. So the government allow, I believe there's up to 7 different reasons why you cannot increase the rating above the F and G to get it to an E or above. Now, the one that certainly springs to mind is that it's financially prohibitive. So if you can demonstrate that it's going to cost too much money to drag your property from an F or a G to an E or above, then they'll allow that property to go into the exemption register. And here's my point, that then the lender will check this, and if it is on the exemptions register, then it will allow that property still to go through, and you can refinance it and get the money out that you want. So that's why that is massively important. Now, on to my second bullet point, which I think is really important, is the surveyor will ask themselves the question when they go around the property: is this property in a lettable state? Now, there's no actual written definition of what a lettable state is, so I'm going to give you mine from just my experience over the years. When the surveyor's going around the property, they're going to ask themselves the question: right here, right now, in the condition that the property is currently at, will there be enough demand from prospective tenants to be able to let the property at the market rent? Will there be enough demand in its current state to let this property at the market rent for that property, of course, in that area? And that's what the surveyor is asking themselves. So that's the question we need to answer. Now, when you look at, for example, the bathroom and the kitchen, the two of the main rooms in the house, of course, for most properties, it has got wear and tear. It has starting to get a little bit tired. Does that mean that there isn't enough demand? Probably perfectly fine. You know, it's still a very workable kitchen, still okay to most people. Most people will let it, happy days. But there becomes a tipping point when that kitchen or that bathroom becomes so old and has deteriorated so much. Yes, it's still functional, but it's somehow the surveyor has subjectively deemed that the condition has got to a tipping point where there's going to be little demand for that property because it will be off-putting to potential tenants. And if we think in our heart of hearts that it's moved to that side of the line, then you may well find that the surveyor is going to say it's not lettable. Of course, you could still let it, but it might be that you've got to let it cheaper. And that's the point, that it's got to be not only lettable in its current state, but at the market rate that you would expect for that type of property in that sort of condition. So that's the question you've got to ask yourself. Now, as a specialist broker in this area, we will, as a matter of course, find that landlords will send us copies of and photos and links to agents' websites of the internal shots of these properties. So if you want us to give our opinion, and it is only an opinion, we're not surveyors, but there's a lot of experience within the office to say whether we feel that property is likely to be classed as lettable or not. So we're more than happy to give our personal view, and you can take that and add that to your decision making. Down valuations. Listen, sadly, as we entered into 2024, properties I'm seeing are being down valued on a probably too regular basis. Now, is that landlords with rose tinted glasses on who are putting in property valuations that are slightly higher than we might expect? Who knows? But nevertheless, we're seeing that. So how can we try and figure out what's a realistic valuation? Well, look, here's a thing to make a note of here. When surveyors go out there, one thing they have to do is to get 3 comparable properties that have actually sold in the area. So that's the bit I want to underline for you today. Actually sold. So there's absolutely no point in you trying to argue with me that there's properties on the market right now, just like yours, that are going for £200,000, and so you want to put 200 grand. But actually, when you look on land registry or look at properties that have sold recently, they've only sold for 170, 180, 190. The surveyor is going to ignore anything that's on the market, and they will be looking at actual sold properties. So here's my point. If you do that bit of research in advance, and you can cherry pick some properties that have sold that do compare with yours, but also are in the ballpark of the valuation you're looking for, then I would put the extra time in. Don't just allow the surveyor to go around the property on their own, or just let the tenant let them in. Meet them at the property, print a report out, give them that information on those comparables, and you're more likely to get the valuation that you wanted. Now, on my 4th point, mix of tenant versus owners. Now, if you are looking to buy a property that's an ex-council house, local authority property, you may not know that within the policy of lots of lenders, there's a little rule that says if the mix, the ratio of tenants on that housing estate compared to those that own and occupy those properties is more than 50%. So if the mix is more than 50% actually renting than actually physically live and own that property, that may well be a decline. And with some lenders, it's a hard decline. Now, you wouldn't know that until the valuation's done, but there is a way of finding that out. So grab your pen and paper, write this website down, www.streetcheck.co.uk. Go onto that website, go onto the housing tab, and within that section, you just type in the postcode, and it will give you the data for that street and that area, so you can see the mix that I've just described. So you know up front, as part of your due diligence when you're thinking of putting an offer in and buying that property, that's really gold dust information to know in advance, because many lenders will not have appetite to lend if, as I said, there's more tenants than owners in that area. Keeping with the theme of council houses or ex-local authority properties is something called non-standard construction. You'll certainly know this phrase if you've bought one in the past, but if not, that's the umbrella title for all the types of build and construction type for local authorities. Well, I'm saying all of them, for a big chunk of them. So that over the last 50 years or so, there's been a whole range of construction types. Now, unfortunately, some of the methods and materials that are being used, in hindsight, have been found to not stand the test of time. And so there's been well-known issues with many different build types. So the first thing you need to find out is, well, what is the build type? And again, come to us as your broker. If you're thinking of buying an ex-local authority property, find out what the build type is. Harangue your estate agent. If your estate agent says, oh, I don't know, it's up to them to find it. Do they want to sell that property or not? Get them to find out what the build type is, let you know, and then as brokers, we will give you more information on whether there is known issues with them, whether there's known remedies with them, whether those remedies should also already have been done, and what sort of guarantees you might want to be looking for. So you're now armed with more information to go back to the estate agent and as part of your due diligence. It doesn't mean that you shouldn't be buying non-standard construction type properties. I've bought them myself, but you've got to go in with your eyes open. And certainly if you go in naively, the surveyor will pick this up, and again, it might be wasted survey fee money that you've paid when you find out that it's of the wrong type and it hasn't had the remedial action and it hasn't got the warranties and guarantees in place. So if you're thinking of buying non-standard construction properties, the takeaway message here is to find out what type it is and talk to us as soon as possible. And equally, if you're purchasing any property, we're more than happy for you to just send us an email, send a link through to the property and say, what do you think? Can you see any issues as far as you're concerned? And again, we're happy to give our two penneth. So to enable you to do that, you can just click on the link below at the end of this piece and speak to the team, tell them about the type of property you're looking to buy, and we will give you our opinion on things you should be looking out for. Questions that want answering so that you can make sure you do your proper due diligence on that one. So I hope that has been of use. Now, in this piece, I want to talk about joint venture insurance. So you should be really interested in this section if you already have a joint venture in place, or you're thinking of doing something like that imminently, or you never know, as part of your plans, your property goals, that at some point you're going to have to do a joint venture to get to your property goals sooner. And joint ventures are fantastic. I've done a dozen or more JVs over the years. They accelerate your progress to achieving your property goals. They can be a key part of your property journey for many of you to get to that really important goal. Usually it's something called financial independence or financial freedom, where you can get your passive income to that level that allows you to do what you want to do, retire, quit your job, travel, do more community charity work, whatever that allows you to do. So it's a massively, massively important goal, isn't it, for you and your family? So having some type of insurance in place to ensure that it doesn't get derailed if the worst happens, then it should be something you should really, really seriously consider. Now, how does it work? Probably the best way for me to describe it is to paint the following picture. Let's assume that you and myself are going to do this joint venture together. We're going to do it on a real simple basis. We're going to be the only two shareholders in the company. We're going to be 50-50. We've both put the same money in to pay for the deposits. And we've bought, let's say, over the last 5 years, we've bought 3 decent-sized buy-to-let or holiday-let type properties, whatever they are. It doesn't really matter. The investment properties within this limited company. And there, there's some added value there. There's some equity growth in there. We've got the profits from the 3 properties in there, and it's all going well. It's doing exactly what we anticipated doing. It's getting us to our property goals, as I said, that little bit sooner. But then one day, I'll take the hit for this one. I'm the one walking across the road. I don't look, and I get hit by a bus. And I'm out of the picture. I'm in a bucket. So the first thing I want to say is, what happens to the shares? Well, they don't come to you because I'm doing all this for my family. So the shares via the estate go to my wife. So now I want to introduce you to your new business partner. Here's my grieving widow, Gillian, who is now a 50% shareholder, decision maker in your business. Now, you don't want her there. And frankly, Jill doesn't want to be there. Now, for those that know my wife, and one of the 2 of you might do, she's got some great skill sets. But property isn't one of them. It's never been her interest. It's never been her passion. It was my passion. So does she want to continue in my shoes, building a successful property portfolio? Probably not. What she wants is the money back out. She wants the value out of the business, so she's got it for the rest of the family and for her, lifestyle, and to be able to somehow carry on. Now, let's assume that limited company has a value of £500,000. That's the equity in the property, that's the profits, etc. Equates about £500,000. You and I are 50-50 shareholders. So actually, the value of the shares that my wife's now holding is £250,000. So actually, she wants £250,000. So she's now looking at you and saying, can I have 250,000? I'll give you the shares. And you're going, well, yeah, if I had 250,000, I'd give you them. So that's the dilemma, that you really would probably want to help my wife out as much as possible. I've got this grieving widow here, but you're not in a position to do so. So how do we square the circle? So here's where this insurance comes into its own. So it's just like any other form of life insurance. It's the same product. It's the same pricing that you would be paying if you got it for you as an individual. But here's the difference. You take out the life insurance policy on my life, and I take out a life insurance policy on your life. In other words, when I fall under the bus, it's not my wife and family that get the payout. You get the payout. So if we take out a life insurance policy on each other's lives for £250,000, which if we were young and healthy, let's just assume for a second, might only cost less than £15 a month each. That's how cheap it is if you don't have existing medical conditions. Then as soon as I've been declared no longer on this planet, then you can put a claim in. You get the £250,000. It's in a trust. Don't need to talk about trust today. Just to know that it's massively, massively tax efficient. Doesn't go through anyone's estate. It gets paid out directly from the insurance company to you. So you have now got £250,000. Now here's the clever bit. There's a legal document called a cross-option agreement, my 3rd bullet point down. And this cross-option agreement ensures that either you or Jill, my wife, can trigger that agreement and force the other side to either sell the shares, i.e. if Jill triggers it, or if it started from your side, you force Jill to buy, to sell the shares to you, and Jill to have them, take the money instead. So either side can trigger this cross-option agreement. And then, in essence, Jill then gets the £250,000. What do you get? Well, now you're 100% owner of that limited company. So rather than your financial goals, frankly, be derailed by a hell of a long time, because what's the alternative? If that wasn't in place, you'd have had to sell possibly, I'd say 2 of those 3 properties to then release the equity, the sale proceeds, to be able to try and pull together £250,000 to pay Jill out. And of course, is the market conditions right to even sell the property at that time? Can you sell it? As the big redemption penalties on the mortgages. There's lots of other reasons why it would be difficult to sell the property at that time. Never mind that it's now put your property journey back a number of years. So with having this in place, it does the exact opposite. You're now that 100% owner. So you are now accelerated on your property journey. You're even closer to achieving that financial independence figure that you'd set out to do back in the day. So yes, I'm no longer here, but financially it's a win-win. My wife gets the money and you get complete control of the property. So it's a fantastic piece of insurance. As I said, it's designed specifically for joint ventures, for collaborations. And so just to finish with, if it's something that you already have in place, because it can be done retrospectively, if it's something you're looking to do, then just click on the link, speak to Victoria, who's our insurance lady. She'll expand on what I've said today, give you a bit more information, give you the figures so that you and your JV partner can then have a proper conversation with all the information in front of them and take a view on whether that is something that is right for you. So hopefully that's been fantastic for you, been really useful content for you this month. I hope you got something out of it. Thank you for staying and watching to the end of this update, and all being well, we'll see you on the next update.